Well, for more on the summit and the state of the European Union, I spoke to John Authers, senior investment commentator for the Financial Times. I asked him why the trade deal between Canada and the US has fallen through.
Well, the key takeaway plainly is this shocking development that the talks to establish a free trade agreement with Canada have broken down over what appears to be the remarkably petty problem that Wallonia, one of the five areas within Belgium, is vetoing it, which the whole incident, I think, does show you how Brexit is already weakening the fabric of the EU and calls into question the ability of the EU to be able to negotiate any kind of a deal. It's a very alarming development, which is plainly overshadowing the rest of the summit.
And certainly another blow for the EU. And obviously this is Theresa May's first EU summit as Prime Minister of the UK following the Brexit vote. So as we started to mention there, what sort of shadow then is the Brexit casting over the talks?
Well, first of all, she has chosen in the last few weeks to make a very clear statement that she's interested in a relatively hard Brexit, at least for public consumption. She's saying she's prepared to lose access to the single market and the various trade privileges that brings in return for taking control over migration into the UK. That's obviously not what the Europeans have wanted to hear, though you've got similar kind of game theory going on, similar chicken games going on from the European side, saying that if Britain wants any kind of access to the single market, then it's going to have to compromise on free movement of individuals. That obviously makes the whole situation very awkward indeed. Plainly, the mere fact that the Brexit vote happened, that it set a precedent both that the population was prepared to vote this way and that the UK is now going to demonstrate to the rest of the Union how a country could leave, changes the nature of the Union in a very different way. It makes it that much possible for a country or even a region within a country, such as Wallonia, where the local politicians have anti-trade opinions, to hold up the rest of the Union.
So in light of this hard Brexit, which countries in the bloc are most likely to see the biggest impact?
Well, it's the Eastern European countries which have the greatest problems with the way that the Union is working at the moment, that would be most likely to treat any precedent as a positive one, that they would be looking for opt-outs from various different proposals. Obviously, if you're not involved in the euro already, you are much less heavily integrated with the rest of the economy. Plainly, also, the Eastern European countries tend to be ones with economies that are running on a slightly different speed from the rest of the EU. So those are the ones that are most likely to be interested in a relatively generous deal for the UK and to treat that as an opportunity to get a better deal for themselves. That explains why the core countries of the EU are talking very tough, arguably even tougher than Mrs May, about making this difficult for the UK to leave.
Now let's also look at the ECB's decision to leave the key interest rates unchanged and also discuss the future of its bond buying program, pushing that decision, perhaps at least talks of it, to December. What impact is that going to have?
Well, that is arguably the biggest long-term issue for the Eurozone, and it feeds into the broader issue for the entire global economy post the financial crisis of 2008. You have a situation where there is very great concern about a number of European banks, in particular about the Italian banking system as a whole, and about Deutsche Bank. While you have very low interest rates, it's harder for banks to make a profit. That makes it harder for them to earn their way out of trouble, to rebuild their balance sheets. So there is pressure. I think in many ways you wouldn't have seen the Eurozone itself fall into a crisis if it had stronger banks. That creates pressure on the ECB to try to begin to normalize rates, to raise rates. You also have an issue that we are now seeing, as they have decided they're going to be somewhat more liberal, that they are apparently going to keep up with the policy of bond purchases that much longer. That is beginning to weaken the euro. That helps European exports, obviously. It makes them more competitive, but it does have the effect of strengthening the dollar, and that is another problem for the global financial system. there's a lot of debt out there that's denominated in dollars. If the euro weakens and the dollar strengthens, it gets harder for lots of countries out there, lots of companies out there, to to repay their US dollar denominated debt. So this is a very central, very difficult issue. There are plainly reasons why you want to maintain very easy monetary policy in Europe, but there are big pressures to try to move that into reverse.